Italtile turnover rose to 1.5 billion rand compared to 1.4 billion rand last year, and gross profit improved by 10% to 626 million rand. Headline earnings per share went up 5% to 34.6 cents per share versus 33.1 cents per share the previous year. The tile distributor company's board declared a final dividend of 6 cents per share. Italtile said the retail environment in South Africa will continue to face challenges presented by subdued trading conditions.
The total market cap 4.5 billion, price earnings 12.8 and a dividend yield of 2.7. Keith, has come to you first. We had Iliad out last week with results that were not so great. These guys really came out in what is a tough condition. Strong balance sheet, good-looking numbers, doing all right in a really tough space.
Well, it's more of the input costs are variable because they're importers and they don't really manufacture it all, whereas Iliad's side,
Iliad's got those fixed costs.
They've got those fixed costs that hammer them when they
buy it.
Absolutely.
Well, let's just also take a look at the operating margin, 29.5% versus 28.7%. And we know that this company has actually been passing on the benefits of the importing of a lot of its goods. Clearly, this company is just really bucking the trend when you see what's happening overall in the sector. So there is demand on the ground, but it has to be at the right price. Right, Anthony?
Yeah, they've been passing on the benefits of the strong rand to their customers. They have been able to extract costs out of the system, but they've also invested in new point-of-sale systems, rolling out new stores. It's a quality business that trades at a premium multiple, but we think that it really is probably worthwhile sitting out of the stock, waiting for recovery in housing, unless it comes back dramatically. You know, I think in this kind of market, if you could buy this thing on 6 times earnings as opposed to 12 times earnings where it's trading now, that would be a good investment proposition. But it's not, and unlikely to. It's very thinly traded and tightly held. But I think it has a quality management team. It has a fantastic track record. It has a quality property book, 1.3 billion rands worth of property on the balance sheet. It has 831 million rands worth of cash.
And almost half its market cap, those two together.
Indeed. So I think that, I think they also make the point that the penetration of tiles and sanitary ware relative to international or other countries in the world is quite low. So there's still lots of kind of upside growth. Fashionable items are starting to get more popular in the rural areas. Gauteng is doing well, coastal regions not so well. Altogether, this is a well-run business, but it is on a premium rating. And there is a lot of visibility in terms of increased housing activity.
Well, it's fascinating because when we see other companies within the lower end space, they're actually really battling and some are really experiencing benign growth. And here you've got a company which, yes, is priced quite, looking quite expensive, but shouldn't it be quite expensive because it is outperforming its peers?
I think a critical point there that Anthony touched on is that how illiquid the stock actually is. I mean, for 4 billion odd market cap company, you can get one at half the size, 2 billion for that cash build, but it's 4 times as liquid, the stock. So your entry and exit cost, unless you're a small retail investor, this is not really a stock for you. And that could actually be why it's so tightly held. Management loves running it, they do a good job, but they don't want to sell it.
And liquidity is always going to be, often you crunch the numbers. Would you go so far as to crunch numbers, find a stock you love, see an abject lack of liquidity? I saw a share today where there was one seller for 500 shares, and then actually walk away from something you like because of that lack of liquidity?
Well, it depends on the play. And the illiquid stocks are either growing aggressively so that they will become a liquid stock in sort of 5-10 years' time, and you're willing to take that incredible long-term view, or they're paying such a good dividend that you're essentially getting cash flows from it anyway, whether or not you can sell it each year. Italtile doesn't seem to be either of these. Its dividend yield is fairly pedestrian.
Yeah, 2.7.
And it's well managed, it's growing, but it's also largely going to track that market, the market's operating in.
Anthony, you mentioned construction, and they said that they're doing a lot more in the renovation space. There's not a lot of new build happening, and when people want to buy but they can't afford to, maybe they go and paint granny's flat or maybe put new tiles on or something like that. Really, what they're going to need, that kicker, is for us to see construction in the housing space really come back strongly.
Absolutely, we think that's several years away. We need to see the banks start relaxing their credit criteria extending credit in the mortgage market. We need to see confidence come back
I
into
didn't
the
say
consumer.
confidence, because you don't want to stop building a house until you're really sure your job is safe, your partner's job is safe, etc.
Absolutely, and the second-hand housing market is much cheaper than it would cost to build right now. So you're going to need to see the housing inventory or stock of unsold houses diminish as well.
And I mean, looking at the GDP numbers that came through as well for the second quarter, looking at 1.3% growth quarter on quarter, and construction posting a 0.5% growth over the quarter relative to mining, which was down 4.2%, just giving you a difference in the view there. Is construction slowly starting to pick up?
Well, let me phrase it this way. I don't think it can go slower. So there's only upside.
Well, it could contract substantially, and it posted a 0.5% growth.
Well, what we're starting to see coming through in the, especially, you need to separate the two. Sort of African construction to South African construction, and all the local construction companies there are volumes and revenue coming through in South Africa, but the margins have shrunk so much because of spare capacity. Guys are bidding for anything at any price, basically just to pay the bills. That the guys are chasing their margin into Africa. So South Africa's local construction sector, the work is there, but there's excess capacity as well. So it's going to be a bad business for a while, and until the excess capacity either goes bankrupt or goes somewhere else.
They've got some operations outside of South Africa, 14 stores in Africa, 8 in Australia. Australia, Melbourne, floods, really, really tough there. The rest of Africa, very, very slow, and chatting with them today, some are franchised, some are joint ventures, some are wholly owned, I suppose doing different ways. And they said, Peter Swatton, who's the CFO, said that the big challenge in Africa, and we've talked about it in this desk before, frankly, is getting the stuff there, is supply lines and the like.
Well, there's different arguments for going into business, into Africa, and different approaches. And I think what they're trying to do is that they are finding the local partnership incredibly important to have. Particularly if you're running a store, you've got to have somebody to manage it well. You've got to make sure that you're positioning your whatever tiles you're getting are going to sell and things like that. So they are taking different approaches. Probably because the circumstances in each different country is different as well. Getting the tiles there, once again, always a problem. And that hits directly into margins. I mean, if you can insure everything and you can make it 100% safe getting in there, but then you're losing the margin, and you wouldn't be playing there unless you wanted the higher margin. So it's a balancing act. It's always going to be.
Okay, so Anthony, you were saying that you'd like to rather see it looking slightly cheaper at a P of around 6. It's sitting at around 12, so I assume not hot for you.
Yeah, I'd also like to see how the foreign competition pans out. The prospect of Walmart coming in here, possibly rolling out the builder's warehouse type format more aggressively, could also create some doubt. So yes, we would rather not be in it, so not hot.
Not hot. And for you, Keith?
I have to agree with that. On the relative valuation, you're looking at peers like Cashbuild, cheaper, more liquid, better yields on it. Italtile is not your preferable entry point into this sector.
Simon?
No, I mean, great balance sheet, strong companies. Anthony said,
great numbers.
Well run, great numbers. Do I want to own it? No, because I'm paying a premium, not getting massive dividend yield. And whilst I've got some construction, the housing space is going to come a lot later than the bridges and the mines.
How are your construction stocks doing, by the way?
Weak.
It's delving to the next stock. Technology company Gijima reported that revenue decreased to 2.6 billion rand from 2.9 billion rand the year before. A net attributable loss of 210 million rand was recorded. In addition, the headline loss per share amounted to 21.73 cents per share, as opposed to earnings of 16.44 cents per share the previous year.
Market cap of 600 million, price earnings negative 2.8 because of that loss. Dividend yield 4%, but that's from an interim. We didn't get a final, so that number is going to drop down to 0. Keith, I mean, we're still, before we came on air, we said we're still talking about Who Am I Online. In truth, we are. At least that's sort of flushing its way through. Cost 269 million after tax. If we took that out, we made about 11, which is still not a lot of profit there, but at least that Department of Home Affairs is moving its way through.
Yeah, well, the underlying business remains profitable, and you almost have to split Gijima into two halves, where you've got professional services, which had the Who Am I Online contract. Miserable year, terrible year, almost right of everything. Then you got the managed services side. That, interestingly, was actually up. That was a fantastic year. It was up 36%. Profits were up 36%, built on the revenues growing about 10%. That's the operating leverage in the business. It's starting to gain scale, and it's falling straight to the bottom line. So almost like a business of two halves and a year of two halves.
And of course, we are very glad to see the conflicts that occurred with Home Affairs behind us now. And just looking at some other divisions, we saw mixed performances coming through, but one that did stick out, Managed Services division posted revenue growth of around 8%. We saw improvements coming through in distributed computing, unified communications and hosting environments. Is that the kind of sector, do you think, that Gijima really needs to start zoning in further?
Yeah, I think the hot sectors in IT at the moment are managed services. I think that if they can capitalize on the whole mobile computing phenomenon and then that move into cloud computing that's going to generate, I think Gijima will do well. But having said that, I think this company has a weak management team. I think it is difficult to see where the earnings growth is going to come from. We think that the exposure to the public sector is still too large, even though it's come back dramatically after the UMI contract debacle. This is a company that is very risky and should trade on a very low multiple accordingly. So we think at possibly 4 times normalized earnings, it's fairly priced.
And Keith, they've been going through cash. They had 600 odd million in December 2009, and stepping down every 6 months down to 87 million. What is the cash burn? Is it Huma Online? Is it just putting cloud servers together, or?
They have been doing a fair amount of capex spending. You know, they're trying to get the managed services. They built the shared services ISC sorry, that was the centralized services.
Yeah.
But largely, I think it was the finalization of the Huma Online. They're in application finalization. They're going to do rollout now, and then hopefully we never have to talk about this again.
What's also quite fascinating, I mean, the Department of Communications, just looking at the value of the ICT markets, it's grown by over 131 billion rand since 2007. We're sitting at in a market of 179 billion rand, and we know that Gijima says that it is going to position itself adequately because it wants to be a leader within the cloud computing space. Do you think that it can pull it off, Keith?
Well, you get different approaches to cloud computing, and my view is that the technology is starting to become pretty commoditized. It's your uptime, your reputation, your pricing, latency, and positioning that really become critical. And then from a back end, it's your cost model. Yeah, on the one extreme end, we have business connection that took huge fixed costs, built massive cloud computing centers. That's a very different cost model to EOH. On the other end, that has an almost entirely variable cost model. They've almost outsourced the data center. Gijima lies in the middle. They've got a modular approach where they can roll it up and scale it out and put it all over the place. So I think it is a safer approach in business connection, not as safe as EOH, but it needs to gain further traction.
I think Anthony would fight you on that, safety of EOH.
Cloud computing, I can't help thinking it's largely a commodity. And I mean, we've talked about it before. ISAs, perhaps, who put the layer of security on top and the like. Keep on looking at cloud computing and saying, I can set up a cloud computer in my garage.
Absolutely. We think that Business Connection is really going to struggle. They've overinvested in their cloud computing facility and offering. It's redundant already. You know, this stuff gets obsolete very quickly. It is completely commoditized, and you're competing against essentially everybody in the world.
Amazon, the S3 servers and the like.
Absolutely. So if you are bullish on the theme, and we are, the best way to play it is through the security idea. Yeah. And the best security company listed on the exchange is a company called ISA, which pays a fantastic dividend and has big upside potential in terms of growth.
Can I touch on that? I think the best way to invest in this theme is actually as the customer. It lowers your costs. So look at which businesses benefit from virtualizing their costs. Yeah. And those are actually the guys who are going to walk out as winner here.
Well, I think everybody benefits, don't they? You know, so I don't think it's you can specifically narrow it down. Anybody with a mobile workforce, with a complex accounting system, with big data storage needs, would benefit from a cloud computing theme.
Okay, so not hot for you, Gijima, then, Anthony.
Ice cold.
Keith, for you.
It's as Huma Online, you know, the risk surrounding that is starting to drop. The underlying business still profitable. The profits are down. Arguably, it's one of those. It's actually not a great business, but if you buy at the right price, it can compensate you for that risk, and that's where I see it. It actually just comes down to valuation.
Is that a hot?
That is a hot. We like it. We have it to buy it at the moment, but it's a tentative buy because it is risky. I need to emphasize that.
Absolutely. Okay, Simon.
That was a long answer to a hot. I used to once own this share, and then came offline, and it collapsed. I like bits and pieces about it, but I'm still looking at it, and I think too many things that worry me. And I say, let's come back in a year and see where they are.